Chapter 10, and we're continuing on with budgetary planning for budgets. And we're going to take it a little further, showing accountability and responsibility as far as budgeting goes. The use of budgets is in controlling operations, and planning for operations is called budgetary control. And basically, it's going to compare the actual results with what we show on the budget, because that budget are basically what the planned results were intended to be, and then we're going to compare budget to actual. Management then is going to be given feedback on the operations that actually occurred and be able to review the differences between what they anticipated the operations were going to be and then what the actual results were. It involves developing a budget, analyzing the differences between the actual and the budget, then from there maybe taking some changes, corrective action, to now modify the budget. So again, as the cycle continues in developing a budget, they can take into account those things that needed to be changed. It works best when a company has some type of reporting system which identifies the name of budget reports, talks about how often those budgets come out, the reports, the purpose of it, and the recipients of them. We know that there can be a sales budget, and there can be reports associated with budgeted to actual sales reports on a weekly basis. Are the sales goals really being met? There can be labor reports weekly, making sure that the labor costs are being followed with what was intended in the budget, along with overhead, selling, income statement. All of these are benchmarks to compare actual with the budgeted figures. Budgetary control involves all but one of the following: A, modifying future plans; B, analyzing differences; C, using static budgets; or D, determining the differences between actual and planned results. C, perfect. Static budget is a projection of budget data at one level of activity. When used in budgetary control, each budget included in the master budget is considered to be static, and it ignores data for different levels of activity, and it just compares actual results with budget activity at the activity level used in the master budget. So here's an example. Budget and actual sales data for the Right Ride product in the first and second quarters of 2014 are as follows. We've got budgeted for first quarter 180, second quarter 210, total of 390. The actual 179, second quarter 199, and it shows you the difference. Now, sales budget reports for Hayes Company's first quarter, we've got here what we're showing. Product line, Right Ride, 180. The actual was 179. So this is an unfavorable variance, which means it's under budget, okay? If instead of actual being 179, if actual was 181, would it be a favorable variance or an unfavorable variance? It would be a favorable variance. Budget report for the second quarter contains one new feature now, a cumulative year-to-date information. So as you see here, for the second quarter, we've got our budget, we've got our actual, and we've got an unfavorable variance in the second quarter of $10,500. And then we've got a year-to-date cumulative variance for the period, for quarters 1 and 2 of an 11,500 unfavorable variance. Static budgets are used for certain purposes. Appropriate for evaluating a manager's effectiveness in controlling costs when the activity levels are going to be in line with what the master budget's activity levels are. And when certain costs are fixed in response to changes in activities. So when we're dealing with variable costs, this is not going to be an appropriate method of benchmarking, but when we're dealing with various fixed costs, it will be. So a static budget is useful in controlling costs when cost behavior is mixed, fixed, variable, or linear. Good. Now we're dealing with flexible budgeting. Flexible budgets project budget data over various types of levels of activity. Budgetary process is going to be more useful because it's going to be able to be adaptable to changes in activity. It's a series of static budgets just based on different levels of activity within the organization. And it can be prepared for each type of budget within that master budget. So Barton Robotics, static budget based on a production volume of 10,000 units. We've got budgeted production, 10,000, and then we've got our various costs, indirect materials, labor, utilities, depreciation, property taxes, and supervision. Overhead static budget report assuming 12,000 units were actually produced. The budgeted shows 1.1 million in expenses, our cost. The actual budget shows 12 million are produced with these costs. Do you see how, based on this, we've got 132,000 of unfavorable variances. Our costs are greater because we actually produced more than what our budgeted amount was. Over budget in 3 of 6 overhead costs. So if we look here, do you see how we were over in our indirect materials, our indirect labor, and our utilities? Those were higher, but we also actually produced more, didn't we? Now this unfavorable difference of 132,000 of 12% over budget really is based on 10,000 units, but we produced 12,000 units, right? So in this case, isn't it meaningless to compare 10,000 units based on cost to 12,000 units? They really don't apply because we produced more. So because of that, our variable costs that we were looking at, indirect materials, indirect labor, it was all going up because we produced more. So it really isn't relevant if we can't compare activity level budgeted to activity level actual. So budgeted amounts, as you see here, budgeted variable amounts need to increase proportionately with production. Because think about it, this report really doesn't mean much, does it? Yeah, we went over, but hey guys, we made more money. We produced 12,000 units, or we produced more base versus 10. So we're going to come up with a new method in our budgeting to show for changes in activity. Okay, and now analyzing the budget data for these costs at 10,000 units, you arrive at the following per unit results. So indirect materials, indirect labor, and utilities end up being $70 per unit. So budgeted variable costs at 12,000 units should give us 840,000. So do you see how that's 140,000 greater than at 10,000 units? So if we then create this flexible budget based on 12,000 units, look how we're actually favorable there. When we were basing it on 10,000 units, those variable costs are absolutely going to increase when we produce 12,000 units or 2,000 more. So we need to have a flexible budget based on our units of production. So when they vary, we can vary our budget. Any questions so far? Comments? Nobody's immune from the effects of declining revenues, not even movie stars. When the number of viewers of the television show House declined by almost 20%, Fox Broadcasting said it wanted to cut the license fee that it paid to NBC Universal by 20%. What would NBC Universal do in response? It might cut the size of the show's cast, which would reduce the payroll costs associated with the show, or it could reduce the number of episodes that take advantage of the full cast. Alternatively, it might threaten to quit producing the show to Fox altogether and instead present the show on its own NBC-affiliated channels. So, based on flexible budgeting, you can make some decisions. See where your costs are, and based on sales revenues going down, how you can modify costs to keep in touch, with the reduced income coming in. Fox's company's management uses a flexible budget for monthly comparisons of actual and budgeted manufacturing overhead costs of the finishing department. The master budget for the year ending December 31st shows expected annual operating capacity at 120,000 direct labor hours, along with the following costs. Here are the variable costs, and here are the fixed costs. So, in developing this flexible budget, we've got to look at activities along with the relevant range. So this activity is really direct labor hours, and we've got to look at what's possible or what applies within each period. And then from there, identify the variable costs and determine the budgeted variable cost per unit of activity for each cost. So as you see here, our indirect materials are going to be $1.50 per direct labor hour. Indirect labor, $2 per direct labor hour, and our utilities are 50 cents. So our variable cost per direct labor hour is at $4. So the fixed costs, depreciation, supervision, and property taxes, those are going to be set no matter what. So we're going to now prepare this budget for increments of activity within that relevant range. We're going to do it within 1,000 hours. So as you see here, we're starting with 8,000 direct labor hours. We've got our variable cost, because we know that, remember, all of these are $4 together. $4 per direct labor hour of 8,000 hours is ultimately going to be $32,000 in variable costs. Same's going to be true. 9 times 4, 36, 10, and 11. So we've got our flexible budget based on the activity levels. What about fixed costs? Do you see how they're all remaining the same? Nothing's changing no matter what the activity level is on fixed costs, but our variable costs need to change, don't they? Fox uses the formula below to determine the total budgeted costs at any level of activity. So we've got our fixed costs plus our variable cost times the activity level to come up with our total budgeted costs. Determine total budgeted costs for Fox Manufacturing with fixed cost of $30,000 and total variable cost of $4 a unit. So what are we going to do here? 9,000 direct labor hours. What are going to be our total budgeted costs? How are we going to begin to figure this out? Any ideas? Anybody?
So then do we just add, do we just take direct labor hours times $4 per unit and then add the $30,000?
Yes, you're exactly right. So we're going to take the $30,000 times 4 plus our activity levels to come up with what our total budget's going to be. Pretty simple, isn't it? Okay. Excuse me here. Okay, so now what we're showing here is a chart showing our budgeted fixed costs are going to remain constant. And then our variable costs are going to increase with our levels of output. So do you see here's the fixed cost line? Here's your variable cost line. In Strassel Company's flexible budget graph, the fixed cost line and the total budgeted cost line intersect the vertical axis at 36,000. The total budgeted cost line is 186,000 at an activity level of 50,000 direct labor hours. Compute the total budgeted cost at 30,000 direct labor hours. What are we going to do? So, our budgeted cost line, 186, we've got our fixed cost and our variable cost. Where they intersect, we're going to show our variable cost times our fixed cost to come up with our new budgeted cost with this activity of 126,000. So I think, how are you guys doing? Should we go through a problem? Should we do that?